Welcome to the Mortgage Wise radio show and video podcast, where we educate and provide expert advice on personal finance, mortgages, and real estate investing.
Show me the money.
As a result of what we do, our team has helped hundreds of first-time buyers, experienced buyers, and real estate investors achieve their goals of home ownership.
I wonder if there's a connection there.
Here are your executive producers and mortgage advisors, Randy and Veronica Chambliss.
What up, everybody? Welcome to another episode of the Mortgage Wise radio show. I am Randy Chambliss. Super excited, guys. You guys decided to drop in. I'm the executive director of Louisiana Housing Authority and also a corporate branch manager with Geneva Financial. And I have to my right.
I am Veronica Chambliss, and I'm also a corporate branch manager with Geneva Financial and a housing director of Louisiana Housing Authority. So I want to welcome everybody to episode number 31.
31, guys. We rock it this year.
So in this episode, we're going to be discussing the myths, truths, guidelines, and eligibilities of an available FHA 203H 100% financing disaster home loan for renters or homeowners whose homes or apartments were destroyed or severely damaged by Hurricane Ida.
Yes. I mean, this is some vital information, as you can tell. There's a lot of truth that's going on, but there's a lot of myths that people just not aware of. So we just wanted to pick this topic so we can give you that information. So you can do your own research, independent research, obviously. So listen, we're gonna just dive right into the content. And so as you can see on our screen, you have HUD, right? This is the resource that you can go to verify any information that you're seeing out there. Some of the misinformation or the myths that I've been hearing, or we've been hearing, is like, it's a grant, right? It's a grant that doesn't have to be repaid, right? Two, that is actually a FEMA loan program that FEMA itself is giving out loans. And those are not accurate information. FEMA does not give any loans, right? So if you call them, they're not gonna know what you're referring to. I think the misunderstanding may have came from, I don't know, but I'm thinking it may have came because this is a FHA loan, right? FHA stands for Federal Housing Administration, right?
Which is backed by the federal government, but they don't actually lend the money. Right,
exactly. So quite simply, in a nutshell, what it does, it helps lenders, it insures loans. That's basically what it is. So if somebody default and somebody unfortunately have to take a foreclosure, that FHA mortgage-backed insurance will chip in to help cover some of the costs and make that lender a little bit whole. That's the whole purpose of it, right? Also, we talked about, I heard things like you don't need any money, at all, like zero, zilch, nothing, zero, nothing. But so we're gonna bring some truth. So you do need a little cash. It's not a actual FEMA loan, things of that nature. So let's just dive right into this right here.
Right, so the overall purpose of this type of loan, which is the FHA 203H loan, is for victims that were impacted by the major disaster and their homes were either lost or their apartments were lost or severely damaged. So this loan actually comes in to help you rebuild or buy another home. Yes, buy another home or rebuild your current home. That's the purpose of this loan. And it came into effect because it's to help the victims that was in the area that the president designated as a disaster area to recover, by making it easier for them to get mortgages and for renters to become homeowners or reestablish them, or people to reestablish themselves as homeowners. And the thing about this is, so homeowners have homeowner insurance, which is a great thing. So even though your homeowner's insurance company pay you off for your home, you can still choose to rebuild and keep that home if you would like, and still take advantage of this program.
Right.
Yep.
Absolutely. So let's look at the type of assistance it is and more details as well. So this program provides mortgage insurance to protect lenders against the risk of a default on mortgages to qualified disaster victims. Individuals are eligible for this program if their home are located in an area that was designated by the president as a disaster area, and if their homes were destroyed or damaged to such extent that reconstruction or replacement is necessary. And that's the key, guys.
That is the key.
You got to really understand that point. You have to be totally destroyed where you cannot live in it, right?
That's the purpose of it. And also, the under are going to be checked. They ask you for proof. They don't want to just see pictures from your cell phone. They want to contact the insurance adjuster and get their pictures along with other reports that they need to prove that, hey, this person was impacted.
Right. And if that person didn't have insurance, they're going to ask for their home inspection report to see those photos, all from a third party, right? Insurance mortgages may be used to finance and purchase reconstruction of a one-family home that will be the principal resident of their homeowner. It can't be a double, it can't be a threeplex or fourplex like we could just traditionally do with an FHA product, but it have to be a one-family home, right? And you have to be living in there, right? that should be your intention to do that. Like the FHA mortgage insurance program, it resembles the 203B, which is the FHA loan. Mortgage insurance for one or homes, right? So here's a couple of benefits, right? One is no down payment required. Borrower is eligible for 100% financing, closing costs and prepaid expenses. Of course, go over that in more detail just a little bit, right? FHA mortgage insurance is the way that we housing development community, because some loans like conventional, they have a higher guidelines, a little bit more stringent process, but FHA allows you to be able to have certain debts on your credit report, have certain collections maybe, right? So it's a lot easier or more lax guidelines to help stimulate the economy.
Yeah.
So approved lending institutions such as companies and savings and loan associations are eligible for of 203KH. So not every lender is offering this product or this program, right? So you have to check with your lender to find out if they do, right? And eligible customers, anyone whose home has been destroyed, severely damaged, and the president declared disaster and is eligible to be able to obtain the mortgage loan. So, that is again on HUD site. You simply just type in HUD HUD and just type in FHA 203H, H as in hat, and you can read this full article in detail because it goes in more detail. But at least you have a resource, and that's why we're here to be able to provide information, give you some education, and just point you to the resources.
Yeah. And one other thing, so it is a time limit on this to take advantage of this program. You have up to 1 year from when the president declared it a disaster area to actually apply for this loan program.
Right. And so here's some of them. We talked about the myths, we talked about some truths, and we just went over eligibility based on what HUD is sharing with the public. So now let's go into some guidelines, right? Like what is required for you to obtain it. So traditionally with an FHA loan, it requires 3.5% down as a down payment, right? So I want you to think about this. There's 3 costs involved, really 5 costs. Let's go with 5 different costs involved when you're purchasing your home. Number 1 is going to be your down payment, which is 3.5% if you go with an FHA loan. So you obtaining a $200,000 home loan, 3.5% of that is going to be $7,000 that you have to bring to the table, right? So put that on the side. Number 1, down payment, 3.5%, $7,000 as our example on a $200,000 loan. The second cost is going to be what we call prepaids, right? These are items that's prepaid in advance at the closing table. For example, your insurance provider, whoever you choose to have for your flood or your homeowners insurance, they're going to require that you pay the premium 1 year in advance. The entire year premium need to be paid in 1 year in advance. So let's assume that their premium is, I don't know, $2,000, right? So that's an out-of-pocket cost, right? Another prepaid is flood insurance. If you are in a flood zone, it's going to be required by your lender to have flood insurance. That needs to be paid in advance, prepaid at the closing, out-of-pocket expense. And then you have what we call title settlement fees. Your attorney or title settlement company who you choose to research the title and make sure that the seller who's selling you the home actually owns the home, right? We've seen that in many cases that they're not 100% owners, right? So they do these research and they research the title and they actually do the paperwork at the closing for you. They have their own fees too, right? So let's assume that that's $2,500, right? So those three items, homeowners, flood, and your title settlement fees are all what we call prepaids, right? So we talked about down payment and prepaids. Now we're going to talk and closing costs, because your title is really closing costs. Right. And then the last prepaid method is basically your taxes for your property. The city, if you're in the New Orleans area, we know the city love to have the taxes, right? So at the property taxes, even though the seller already paid it already, but you got to pay it 1 year in advance. So those are some of the costs. And the last two is going to be, one is going to be your appraisal for the home, right? That's an out-of-pocket expense, right? Also your home inspection, right? You may want to really consider getting a home inspection. So the home inspection may be $600. The appraisal fee might be $700, right? Those are all out-of-pocket expense.
And that's what I tell people up front. And when people come and say, oh, well, I don't have no money. Well, you need some money, because before you even start the process, you have to give the seller a deposit to hold the property and promise to not sell it to someone else that come along with cash or better financing or what have you. So that's anywhere from $500 to $1,000. In some cases, depending on the purchase price, it may be up to $5,000, right? Or you may be in a bidding war. You may want to put up $5,000 just so the seller will say, okay, well, this person is really serious, so let me take their offer into consideration. Also, like Randy said, you have to pay for your appraisal fee. You have to pay for your inspections. Inspections are anywhere from $500 to, let's just say, $800, right? You also have to pay, and again, I want to throw this out there too, because the lender never require, I'm not gonna say never, we don't require you to get a home inspection, but we highly recommend it on every property that you purchase, right? So it's worth the cost. So I'm the type of person, I'd rather pay $500, $800 now just to save me thousands of dollars worth of headaches down, because this home might look beautiful, but they may have some issues that you can't see, right?
Yeah, underlying issues.
Right, so I tell people when you come, you may want to have at least the minimum $2,500 and up just to get started, right?
Yeah, because basically what that does, just to piggyback real quick on a home inspection, you can't see the pipes under the house or under the ground. You can't see that, but the pipe inspector can. Him or her have video cameras, right? So, those are all out-of-pocket expenses, right? Now, let's look at some solution to those items, right? You might be saying, well, damn, I'm kind of scared right about Randy and Veronica. You didn't ran me away from home ownership, right? But listen, we want to be upfront, we want to be honest, we want to be direct. So don't get so super excited when you hear 100% financing, no down payment, that you think just because you have zero money that you could get in. No, we want to set proper expectations. Here's some solutions, right? Where can the cash come from? Where do you literally have to have this type of money in your bank account? And typically the answer is no. If you have a IRA account, if you have a 401k from your JOB, you can use your funds, those funds, to cover your closing costs and those prepaid items that we talked about, right? Those are allowed. Also, if you have a charitable company, right? That's a charitable organization. They can give you a gift, right? A family member can give you a gift. Mom, dad, cousin, uncle, etc. Right? Brother, sister.
Even your employer can give you a gift.
Right. Even your employer can give you a gift to help you with your closing costs and prepaids, right? Even towards your down payment, if you're not, getting the 203H FHA that we're talking about, right? So you have all these different opportunities, even investment accounts, as I'm thinking about it. You have an investment account, you can use that as well. So now that we talked about some solutions to obtaining that, oh, I forgot one. The seller can also contribute to some of your closing costs. up to 6% of the purchase price. That, my friend, is huge. For example, you have a $100,000 home. 6% of that is what? You guessed it, $6,000. If you have a $200,000 home, you're $12,000. That means the seller literally can give you $12,000 to be able to help you to cover that cost. So in essence, you can walk in and purchase a home with no money down. It can, but it have to be strategic, right? 100% financing, no down payment, and then the seller can contribute to all your closing costs, right? You might have a few $100s left over. Now, let me warn you, right? Let me get that disclaimer out. It's not a guarantee that the seller will say yes. It was a highly possibility before this pandemic and before it was in this seller's market. It was a highly practice that we seen. Like me and Veronica did this a lot with the houses that we sold and bought, right? Now, with that being said, it's negotiable. The seller might say, well, I'm not giving you 6%, but I'm willing to give you 3%. Something is better than nothing, right? Or they can say, I'm not giving you anything. I'm sorry, it's not going to work. Hey, we get that. So just know that it's a possibility, but it's not actually guaranteed. So I hope you guys got some value of that. So Veronica, let's talk a little bit about how individuals, like what type of question that a lender would ask them. Like, what are we looking for when individuals looking to buy a home?
The first thing we look for is a credit score. What is your credit score, right? We want to know, basically the lender want to see your credit score because your credit score says a lot about what type of person you are, your character. Do you pay your bills? If so, do you pay them on time, right? We also ask, hey, are you employed or self-employed? We want to know what type of income you have coming in. You want a mortgage loan, we need to know how you're going to pay it back, right? The third thing we ask, how much you have saved up. Why? We need to know before you even get a pre-approval letter to go shop for a home. And that's what people don't get. That's another thing. To get a pre-approval letter, you have to prove that you have all these things that the lender required to close on your home. Why? Because in that purchase agreement that you signed on, I forgot what line number it is, but it does say that you have all of the funds to close this loan, that you have all of the requirements that the lender do require to close this loan. If not, you can possibly be putting yourself in a bad situation to losing your deposit if something down the line come about, right?
Right. So you don't want to put yourself in that position. Then from a moral standpoint, ethical standpoint, and just your peace of mind, right? You don't want to start shopping for your home prematurely. Where you out, you with your realtor partner, you're looking at home, you fall in literally love with this house, you found your dream home, and you do your negotiation and it get accepted, but your lender never looked at your documents. They never looked at your bank account. They never calculated your income. They just verbally took your information. So, you want to look for that pre-approval because pre-approval is a hell of a lot better than the pre-qualification.
Right. So pre-qualification is basically you telling us stuff out of your mouth, right? We're not verifying no documents. Right. But if you want a pre-approval letter, you have to give us some documents so that we can verify, okay, well, this person is good. They can go shopping, right? They
but
got the money.
They won't. You can have whatever you like. And so, yeah, absolutely. So you want to put yourself in that best position because once you lend us see these documents, now you're comfortable, you're confident, and it's just game on, man. That's just gonna make it happen, right? Anything else that we're looking for? We talked about the credit. We talked about the money and the cash to close. We also looking for DTI,
which is
debt to income
ratio,
right?
Not debt to credit ratio, debt to income ratio, right?
And what that simply means is that when we see your credit reports, we see all 3 credit bureaus, and we're looking at those monthly expenses that's going out. We're not looking for cell phone bills and water bills and electricity bills. We're looking for those private loans. We're looking for auto loans, student loans. We're looking for those type of expenses that goes out monthly. Then we take a look at your income that you're coming in. If you are self-employed, we're looking at tax returns. That gives us an idea of what you earned in the past. We're also looking for a profit and loss statement. That's the most recent. So we can see what you're doing today, right? And then of course, if you're an employee, right, working for someone, then we're gonna look at those W-2s to see what you earned in the past. And then we're gonna look for recent pay stub to see what you're earning now. So now we can know, okay, this is how much we can use for income. Here's the expenses that's going out, and this gives us an idea of what you can qualify for, right? So that's the purpose of, being prepared, right? You just want to put yourself, before you call it, just be prepared. Just analyze your finances and say, okay, let me go check my own credit score, right? My recommendation can't tell you what to do, but I will use FICO, right? myfico.com. You can swing over there. It is a small fee, but that's the best and closest credit score that you can obtain that the lender uses, right? So now you check your scores, you're okay, things looking good. And for example, like this product that we're talking about, which is the FHA 203H, it can go down to a 600 credit score, right? Literally, right? So just check your credit score. So that's what we wanted to share with you guys. Now, switch gears a little bit as we wrap up. Let's talk a little bit about a down payment assistance. Perhaps you may not qualify, or perhaps you know someone that may not technically qualify for 100% financing from the FHA 203H because they may not been in a home or apartment complex that was totally destroyed. So they're not eligible. Well, we still have 100% financing for New Orleans and greater surrounding area, all of Louisiana, right? And that is in the form of a down payment assistance. You still get the FHA product, 3.5% will be required, but the down payment assistance can cover that 3.5% for you. And possibly we can maybe get you up to 5%, which 3.5% gonna cover the down payment, and then the remaining will roll over to your closing costs. The other criteria still remain the same. You can still use funds from your retirement account, 401ks. The seller can contribute. You still can get a gift. All that stays the same. So just know, if you know anybody that's in that situation, we have that down payment assistance form as well. Anything that you want to share, Ryan, before we close out?
No, that's it.
All right, guys, listen, it's been exciting. We just want to disseminate this information. We do free consultations, so feel free to give me a call at 504-270-2783. You can call, text. Again, that's 270-2783. Call and text me, or if you see me on social media, you can always inbox me. And also you can find me online at randyknowsmortgages.com, randyknowsmortgages.com, and find me on social media at Mr. Randy Chambliss.
Yeah, and I can be reached at 504-715-4388. I'm also online at knowsmortgages.com. I'm also on social media, Instagram, Facebook, and I think that's it.
Well, listen, guys, you enjoy the rest of your day on purpose, and God bless. Twitter, we do Twitter these days.
Have a good night.
Who does Twitter? Good night, everybody.
Night.
Good night.
That brings today's show to a close.
Oh, come on!
Thank you for listening to the Mortgage Wise radio show and video podcast. If you enjoyed this episode, feel free to share it with a friend and subscribe. Please follow us on YouTube, Instagram, and Facebook at the Mortgage Wise Radio Show. If you want to learn more about what we talked about today, give us a call at 504-270-2783. Or to view our podcast library, please visit our website, themortgagewiseradioshow.com.
Autobots, roll out!
Until next time, choose to have a great day on purchase, Mortgage Wise friends.
Go home.
All right, guys, enjoy the rest of your day.